Hello, everybody. We're here live on Zoom. It doesn't look like anyone checked in yet, so we're going to give a couple of minutes to let everybody roll in. And now they start to come. Beautiful. All right. So we got a few people logging in right now. And guys, while we wait for everybody to join and attend, I'd like for whoever is new to Zoom, just to get yourself a little bit familiar. We want this to be really interactive. Let your questions kind of roll. If you have something you didn't understand, something you want clarification, make sure to let us know about it. You could use the chat section on the bottom. Now, when you do it, there is an option you could choose either to send it to all panelists or all the attendees and panelists. So keep that in mind. Also feel free to network with each other. Let everybody know where you're from, what you're here looking for. Maybe, you're looking for a partner. Maybe you're looking for capital. Maybe you're just, trying to learn something or a little bit more about real estate. So feel free to let everybody know who you are, what you're looking for. And, hopefully you never know, someone can reach out to you and be a good match. So we'll give everyone a few more minutes. Probably less than a few minutes, probably like a minute or two, and then we'll get started.
That is one of the nice features about these, sharing your kind of your aims and things like that, so people can see if it's a match for what they're doing, huh, Max?
Yeah, it's honestly, it's incredible. Like we were just talking, me and Clay were just mentioning, how networking has changed so much in the last 3 months because of COVID. It's not just our businesses that have changed, but also the way we network with people now. And, it definitely opens up a lot more opportunity and accessibility to really, save some time, still get in touch with people, stay connected, be able to see each other still face to face. So that's all really important. And definitely, like I said, let people know what you're looking for, what you're looking to do. You never know where you're going to find your next partner. You never know where you're going to find your next deal. Could be here, could be at the gas station talking to the guy while you're filling up gas. You never know. So just remember, always be closing, always be talking, and always be strategizing. But so let's get started, Clay. So the topic tonight we have, first of all, I want to introduce you properly. So Clay, I'm going to let you tell us a little bit about yourself, but one of the really cool things about you and that we've been talking about is that you're not just a self-directed IRA strategist and consultant, but you also actually are an investor from your own self-directed IRA. Is that right?
Exactly right. Yeah, I think it's a great tool.
Absolutely is. It's definitely a good source of money, an easy way to tap into your money as well and use it and leverage yourself even further. And we'll get into that. We'll obviously go into all the nitty gritty. But before we do, Clay, tell us a little bit about yourself. Tell us a little bit also about what an IRA is. So for all of our attendees, I'm sure most of us do know what it is, but for those that don't, just explain to them what an IRA is, how it works, and what the benefits are.
Sure. So a little bit about me. I've been in the self-directed IRA business for about 10 years, coming up on 10 years now. A lot of it is just education. So I've taught continuing education classes for CPAs and CFPs, a lot of real estate professionals, as well as investors like yourselves, and pretty much anybody who is interested in the concept of an IRA investing in something other than Wall Street. Mm-hmm. And I started doing that type of investing almost simultaneously with with getting into the business, because I was a little bit behind on my retirement savings. I knew that the tax advantages that were involved would really be a benefit to me, kind of accruing some retirement assets. And I liked alternatives. I like real estate. I like those kinds of investment opportunities. And so it was a nice combination. And when you say, go back to the beginning about IRAs and what do they, what's their benefit and how do they work? It really is, IRAs started in the 1970s. Prior to that time, the people's retirement usually was a pension or some other employer sponsored kind of thing that had some tax advantages to it. But in the 1970s, because of the way people were, they didn't have one job their whole lives and they started to be more mobile and things like that, the government decided to add some of those or allow some of those benefits, the tax advantage benefits, to be used by an individual and have them be portable. And so I think if you talk to any financial professional, a CFP or a CPA or just, any of whoever your financial team is, most of the time they will tell you that the really powerful part of an IRA or 401k or those retirement type plans is that the money can compound faster. So when that money has been contributed to that plan, it takes on some tax advantages. In a traditional IRA, obviously you get a deduction for the contribution. So that helps in that tax year. But once that money has been contributed to the plan, to the IRA, when it invests and makes returns, those returns don't get chipped away by taxes because the earnings are tax deferred. And therefore, as soon as they come back into the IRA, they're ready to be redeployed and invested again. And that lack of having the taxes chipped away means that that money rolls and compounds much, much faster. And if you've ever seen those charts of the compounding, it doesn't look terribly impressive at the beginning, but once you start to get toward the end with a few years behind it, the amount of gain that you get from having the ability to have that money reinvest in its entirety is really amazing. And then, of course, the traditional IRA, when you take distribution, that's where the tax event is. So when you take a distribution in your traditional IRA or most 401ks, whatever the gross amount of the distribution is in that tax year will be taxed, but it will be taxed at your income tax rate then when you take the distribution. So one of the things that I think was always part and parcel to the benefit here was that if you're making your contributions in your earning prime, the presumption would be that your income tax rate would be higher at that point. Whereas if you take a distribution and you're not working anymore, you're working part-time or things like that, your income tax rate might be much less. So your overall tax burden is really eased by having the deduction at the beginning, tax deferred in the middle, and then taxed on the way out, but at that income tax rate. So using it, and I often refer to IRAs as just a tax tool. And so you want to take that tax tool and use it with investments that work, and that's where it really gains its power. And, I see Max smiling over there, so I'll just finish off the thought about because a lot of us have now, Roths came about in the 90s, Roth IRAs. So that's the other tax tool, and it's slightly different in as much as the tax event is at the beginning, right? So when you make a contribution, you don't get a deduction in that tax year because it's post-tax money. It is still tax deferred as it's making earnings. And as long as you take a qualified distribution, meaning that the Roth has been open for at least 5 years and you're at least over 59 and a half, it's actually tax-free on the way out as well. And so it is just as powerful a tax tool. It's slightly different. Neither one is necessarily better than the other. A lot of it has to do with the particular scenario, but they're both incredibly powerful and they both have that ability to compound the money faster.
Of course. And that's really one of the strongest tools in an investor's kit as far as leverage is the ability to compound their money as quickly as possible, as much as possible, so that they consistently have it going in and bringing in return. And, the more it compounds, obviously, the more profits there is in there. So that's always a good thing. One thing I'd love to just, touch on a little bit more, because you kind of brought it out, is, it's tax deferred. And we use this term a lot, and people could confuse it a little bit. Sometimes at first they're like, oh, I don't have to pay taxes on this. That's great. And then they realize, well, I have to pay taxes at the end, when I either make my, what do you call it again? When you take
distribution.
Distribution.
Yep.
So one of the cool things, though, that most people forget is that that's actually a deferment is one of your most powerful leverage tools, because the fact that you're not paying it today and you're able to hold on to that money and invest it and make money off of that tax dollars that you were supposed to pay and not see, because It's Uncle Sam, you know, he's not easy to deal with.
Yeah.
So that's actually a really cool tool. I mean, we see that all the time where, you know, investors doing 1031 exchanges, and it's for the same exact reason, the ability to use those funds today to make
Yes.
more money so that they can retire properly. And sure, I'll pay it on the way out. So that's honestly one of my favorite things about it. Now, tell me a little bit more. So have IRAs always been self-directed? Is this something kind of new into the market that we're seeing, or is this something that's been around forever?
Yeah, it's a great question. And it's often a term that's kind of misunderstood. So, in a sense, self-directed has always existed. The rules that allow your IRA to invest not just in stocks and publicly traded securities and on Wall Street, but also alternatives such as real estate or notes, private equity, things like that. Those rules really haven't changed. The thing that was interesting is, so in the 1970s, when IRAs came out, banks and brokerage houses kind of seized on it and built a business model around it. So what they basically said was, hey, we'll be the custodian for your IRA, but while your IRA is with us, it can only invest in the things that we sell. And then the banker brokerage house would get a commission on the sale, and that's how they made their money. That was a revenue model. No harm, no foul. And you know, when the stock market is performing in a regular manner or a consistent manner, there's, you know, it works for a lot of people. I think that in the last 20 years or so, you've certainly seen more radical movement in the stock market, and that has really brought interest to the idea of alternative assets. And so this concept, this term, self-directed, it's actually not a different account type. It's not a legal distinction. It really is a descriptive term, and all it really means is that the account holder is going to have some choice in terms of the assets that money that has been contributed is going to purchase. So a self-directed IRA at Schwab or Fidelity or something might be one where they say, okay, well, you can self-direct it, you can make the asset choices, but you have to choose from between these 10 mutual funds and these 15 stocks.
Right.
And again, no harm, no foul. And because you're making a choice, that's self-directed. But I would say that the more common use of the term self-directed means that the custodian that you're with will handle alternative assets or private assets. So something other than publicly traded securities, again, such as real estate, precious metals, and notes and things like that. So, you know, and I'll dig down to the very bottom of this. When you have an IRA, you've actually made a deal with the government.
Yeah, tell me more.
The deal is this. The IRS says, I will give you these tax benefits for years or even decades if you do two things. One, you have to have a qualified custodian, because the money is being kind of held in a trust. And the reason it's being held in a trust is because the IRS is tracking it to make sure that the tax event is what they think it should be. So you have to have a qualified custodian, and then you have to follow a few rules, you know, no self-dealing and a few things like that. So, but once you do that, then you get the tax benefits. So that's really the agreement that you've struck with the IRS. Now, the IRS does not say to us qualified custodians, you have to handle every asset that is legal, right? So each custodian actually builds their own business model around the rules, but it can be around this set of rules or this half of the rules or this, you know, it can be a partial, right? So, you know, I work at a place where the custodian handles all kinds of alternatives. And so I would say that if you hear the term self-directed IRA on the street, most likely what they're saying is that IRA is with a custodian that handles private assets or alternative assets.
Got it. Got it. So, and just to clarify, so what you're saying is, and just one more thing also to clarify for the audience, if they're not familiar with a custodian, and correct me if I'm wrong here, a custodian is pretty much the overlooker of the file, like similar to like a hedge fund, the one that's in charge, making sure that where the monies are going, investing into the right places, and so on. Am I saying that correct?
In a manner of speaking. So it really is more of a tracking mechanism than an advice mechanism. So the custodian actually does not give tax, legal, or investment advice. The custodian's role is really, a custodian is a trust company or a bank or a brokerage house. Sometimes an insurance company will file to be a custodian, and other entities can too, but most likely it's a bank or brokerage house or a trust company. And what their role is to be the cash position and the bookkeeper and recorder of the activity of that account, right? So that if the IRS ever wanted to look at that and say, hey, we saw that you made contributions for 3 years in a row, that's X number of dollars, where did they go and what did they do? Well, the custodian would be able to say, well, it was deployed for this investment, it got this much return, so on and so forth. So there'd be a complete accounting for how that money interacted with the marketplace, and therefore gets to have the tax benefits, right? So the custodian is really an important part of the equation. You want to have one that's, good at customer service and experienced at what they do, because they're really preserving your tax benefits for the returns that you're making on the investment.
Understood. So know who you're working with before you just do it. It's not all IRAs are the same, is what it sounds like to me.
Right. Well, that's always the case, right, Max? You want to know everybody in the equation, what their role is, so that you can operate it at its optimum efficiency, right?
Of course.
So it is another part of the equation and deserves due diligence, just like everything else.
Of course. And like you say, everything operates on its own level. That's why it's important to really know who you're working with and understand how it works before you just jump into anything. So that's why I'm really glad you're here to really advise all of our attendees and anyone that listens to this on YouTube later, pretty much how to, understand how this works, how to ask the right questions and work with the right people. Right. So now, Clay, tell us a little bit now. So now what happens to the returns on my investment? So now I took out $100,000 from my IRA. I invested in real estate. I made $50,000 on it. What happens to that money?
Well, first of all, it's a great return. Nicely done. Yeah, and if you don't mind, I'll run through the whole kind of logistic equation on a basic level, just so that everybody gets a sense of it.
Yeah, please.
So the most common thing is, and I will say this because a lot of people have 401ks at companies where they no longer work, or an IRA that they started contributing to but then stopped. And so lots of people have money in tax advantaged accounts. And they may or may not remember that they do, or exactly where they are, or how much they are. So first thing I'll say is take inventory of all that stuff, because the account holder, the person, actually has power in terms of moving it around and combining it and putting it into position to invest. So, don't lose track of what you have out there. But that said, the most common scenario that we see is this. Somebody will call us and say, hey, I have an old 401k and let's say a small traditional IRA somewhere at a brokerage house. And they'll say, what I really want to do is invest in real estate or a note or whatever it is. And we'll say, great. So they open up an account, takes a day or two. Therefore, that is another account, and it's an account just like any other at a bank or brokerage house. So whether it's traditional or Roth, a SEP IRA or a simple IRA, health savings accounts can do this. The account type stays the same. Contribution rules are the same, distribution rules are the same, tax benefits are the same. Again, all we're really talking about is the alternative asset part. So the reason that they're moving the money or making a move is so that they can access the alternative asset. So they open up an account with us, therefore there's a place for the money to go. They do a rollover or transfer or both, or they also make a contribution if they're eligible to. And the point of that is to get some money into that account, right? So you have some cash to spend. It is all still under the tax sheltered umbrella. So whatever it does is still sheltered. And you should make sure that cash position is FDIC insured, just, to be safe about it and that kind of thing. But at that point, the account holder is looking for, what am I going to invest in? So in this case, if let's take the really basic one. You said $100,000 investment over some period of time, it makes 50 grand. So at the inception of that investment, the account holder comes to the custodian and says, hey, this is the paperwork of the deal that I want to do. I'm going to authorize you to send $100,000 out of my IRA to the investment sponsor or the issuer or the seller of the house or whatever it is that you're buying. And because we have your written permission to do that, and we have the paperwork that substantiates what that IRA is buying, we do it. Money goes out, whatever the investment is. In this case, Max got the golden touch. So $50,000 on top of the $100,000 comes back. And that all goes right back into the cash position in your IRA. That's the earnings, right? So instead of your IRA having made money on a stock dividend or the stock price going up and you sold it or something like that, you made money on buying and selling a house, or you made money on investing in a note and the principal and interest payments came back into your IRA. But it is kind of a closed financial system until you take distributions, right? You can always do that. But while it's operating, while it's accumulating earnings, it's a kind of a closed financial system. So your IRA paid for the purchase and funded the investment, and it gets all the returns, and it's tax deferred. Right. So then as soon as that money comes back into your IRA, it's ready to be redeployed if that's what you choose to do with it next. So that's the basic schematic.
Understood. Okay. And just so you know, Clay, these numbers are actually something achievable in real estate. It's not that far-fetched. I see it pretty often. So hopefully we could get you some of these returns as well.
Well, in my head, you made the 50 grand in like 10 days. So
that's okay. That's fair. That's fair. 3 to 6 months. But so that's really interesting. So everything kind of just goes back into the account, and it just keeps operating until you're ready to take it out. So everything stays there. You're able to reinvest that money, find your next property, reinvest it, find your next note, or wherever you're investing it into your IRA to. So now, is there anything special that I need to have on my IRA to invest, let's say, in real estate, or could I just take any IRA that I have right now and say, well, I want to move this into and buy a new house that I just saw and flip it?
Yeah, I think the catch there really is what we were talking about earlier, is matching the custodian to the asset. Okay. So you do have to have the money positioned at a custodian that handles whatever it is that asset is. And as I mentioned, certain custodians do certain assets, but once you have it there, then absolutely. One of the things that I really like about this type of investing for myself and for most people that I hear, you get to invest with the people that you know and you understand, right? So if you know how to make money outside of your IRA, most likely you can make money using the same strategy inside your IRA. Now you need to take a little bit of time at the beginning to set it up properly. Your IRA is actually a different legal and financial entity than you personally, because it has different tax advantages, right? So it has its own name, it has its own bank accounts, actually it has its own tax ID number separate from your personal situation, but you operate it. And so you're providing the strategy. So if you've had a successful investment with your personal finances, chances are you can do that exact same thing inside your IRA. So you get to use your own real estate team, your own financial team. Again, the custodian is not supplanting anybody. We're very neutral part of the equation. So you bring all of that expertise and that strategy with you. So that's one of the things I think is really great, because if you've had success, then you get to just keep playing that hand, right? So
right. If you're doing something right, don't stop. Just let it keep turning, let it keep moving, and you'll be all right. And that's exactly, why a lot of people, and we're seeing it more and more now as a lender, where I'm seeing people pulling money out of their IRA to do deals. And honestly, it is one of the smartest things they could do, because some of them wouldn't be able to do it without it. Some of them, they just, they would have stopped at maybe 2 projects, and now this allowed them to do a 3rd or 4th. So it's actually really important to be able to leverage yourself, and like you said, compound, not just on the IRA, but also on your business. If you're doing fix and flips and you're doing 4 a year and you're trying to get to 10, well, and you have an IRA that you could tap into, well, that would be a huge catalyst to help your business grow and scale it. So that's really awesome news. So now,
and can I just say one thing too, Max? That I realize this is super ticky-tack, but the vocabulary is tough in a niche industry, right? So one of the things I do want to stress is that when your IRA makes these investments, buys a piece of real estate, or is the lender on a note or something, while the money kind of physically leaves the IRA, you're not actually taking it out of the IRA. You want to make sure that it stays in the IRA, and that's why it gets to keep the tax benefits. So, because I've actually heard people with an agenda say, yes, take distribution, take the 10% hit on the money that you've saved. Oh my goodness, take 10% hit and pay the taxes, get it out of the IRA, and then invest it. But I think that mostly comes from not knowing that the money doesn't have to leave the IRA first to do that investment. So good heavens, if you want to invest it, invest the whole thing, right? Don't invest 60% of it because you just paid 30% taxes and a 10% penalty to get it out.
Right. And that's a huge point. And so that's actually something that I'd actually like to touch on as well. So us as a lender now at Express Capital Financing, we don't source our funds. So some lenders may only use or allow you to say, well, if your IRA has 100,000 in it, we're going to give 60 or 70% of that, sometimes 80. So figure 70,000 of your entire IRA is allowed to be used or capitalized on. Well, you just lost 30%. Right? You just left out money that you would have had on the table to invest. Here, we don't source funds. So whether it came from under your mattress or from your IRA or from mom and dad or your hard-earned money that you made from work, that is all fine for us. So we're not going to source it. We're not going to ask you to see where it came from. So you can actually utilize your full IRA when you are investing, whether it's in real estate or anything else. So now,
it brings up, can I ask you a question, Max?
Yeah, absolutely.
So as an investor, one of the things I see sometimes is that sometimes a family will combine all of their IRAs in an LLC, or sometimes they'll have an IRA and then some personal funds in an LLC, and then that LLC entity goes out and makes investments. Is that a viable thing at Express Capital Financing if somebody came to you with an LLC that had a couple of different investors in it?
Absolutely. That's absolutely fine. And not only will we allow that, but we're actually going to take the best from all the worlds. So if John Smith has credit and Mary Smith has the experience and the IRA has the capital, well, we're going to take all three of those together and make one super file so that you get the best possible terms. So you're not going to lose out just because you didn't have one thing or another. As long as you have a partner in the deal that can bring that to the table, we're going to allow that to fly.
Got it.
So it leaves a lot of opportunity. So now, Clay, here comes the question that, everyone's looking to hear, so you're telling me all this good news. You're telling me I could make more money using my IRA. If I have higher returns, go ahead and make it, and I could pay my taxes later. What's my cost? How is Advanta IRA getting paid? Are you taking a percentage? Talk to us about that.
Sure. Well, I mentioned earlier the way that banks and brokerage houses had typically structured their revenue model for IRAs. A company like Advanta took a different approach, and there are others like it. It's not completely novel, but it's really more of a fee for service kind of model. So things like it's $50 to open an account. When you purchase or sell something, there's a transaction fee. So when your IRA wants to be on a note, it's a $95 transaction fee. So we charge for the thing that we're doing. So it's much more like, so because we don't sell any assets, we don't give any advice, and we don't take any percentages from the returns. It's just not the way the revenue model was built. It's much more of an upfront, hey, here's a list of things, you choose what you're going to do, and this is what it costs, and so on and so forth. So the actual cost for any particular account holder is tough to calculate unless you know exactly what they're doing. It's usually in the hundreds of dollars a year. There's some super active folks that sometimes are in the 4 digits, but in terms of our fees, it's usually somewhere in 3-digit land. And it really, you'll get all of that disclosed up front. And so you'll know what that is, but it's more like hiring somebody to do your taxes or do your bookkeeping or things like that, pay them a fee to do the service, rather than they're going to take a percentage or they're going to be part of the deal or that kind of thing. So it's a markedly different revenue model.
Understood. So whether I'm making 10% of my money buying notes, or if I'm making 30 to 50% of my money investing in real estate, I have the same fees regardless for each transaction or each service that I do.
Right. And in lots of cases, people have their annual fee with us is a flat $295 per asset per year. Doesn't matter what the asset's worth. And part of the reason that it's like that is because same amount of bookkeeping for us, whether it's worth 10,000 or 10 million. So we just charge you for what we're doing. But what that does allow is for the account holder to, pick the fee schedule that'll work for them and what they're doing.
Understood. Wow. So that's really interesting. So that means that, honestly, the more you're investing, the more you're able to make off of your money. This, opens that opportunity for you to leverage yourself again. I know I keep mentioning this, but it's super important because it's something that, it's on my head all the time. It's how can I have more access to capital? How can I spread my money around more deals? How could I diversify myself a little bit more? And how could I even reduce some of my risk? So these are all things that really, are going to help out a lot of investors. And I think a lot of them should be reaching out and just understanding this, whether or not they have one already or not. So now if I already, and I know we discussed this a little bit, so if I already have an IRA with ABC, let's just say, am I able to come to you and transfer it of any sort, or would I have to start completely new?
Yes. So absolutely. You're, as the person who is the account holder, you actually are able to position that money and move it around. In most cases, no tax, no penalty. And you can have as many IRAs as you want. A lot of people don't know that. I went a little overboard because I'm in the business, so I have a lot of them. So it's very common for somebody to have an IRA at ABC brokerage house and one with us. Right. And to do transfers back and forth according to what's happening with the marketplace. So your ability to adjust to the marketplace and to diversify is really enhanced. So it's really a common misperception that once your money is in a 401k or in an IRA, that it's frozen solid and you can't get to it, and it's just, all you can do is look at the sheet that tells you what your returns are. That's not the case. So your ability to position it is probably greater than you might have imagined.
Understood. So I actually got a question here that came in from David. So he's wondering, how long does it take to set up an IRA, and what's needed? So if somebody wanted to go to the next steps, what would that look like?
Yeah. So basically they would contact me and get them an application. The application is very easy. It's mostly personal information about address and identity verification, all that stuff we have to do in the banking kind of industry. The account gets set up in a day or two, and then it's really the rollover or transfer. I would say that you should ballpark that at 3 weeks, give or take a week, just because it involves the resigning custodian and that kind of thing. But again, the rollover or transfer properly done, there's no tax event and there's no penalty to it. You're really just moving your money from one custodian or trustee to another. So as far as the IRS is concerned, it's still never left the umbrella. So 3 weeks or so until it's in the cash position and ready to disperse. And during that time, you can be working on the investment that you want to be in. So assembling the paperwork and working with your account manager to make sure that we know what's going on and that kind of thing. One of the interesting things that is slightly different about IRA investment is that the custodian is actually the signer for the IRA's investments, because it is operating like a little trust. Mm-hmm. And so the paperwork has a little triangulation in it, in as much as once the investment paperwork is established, it goes to the account holder, and they write read and approved and sign it in the margins, but not on the investor line. And the investor line is actually an authorized signer for the custodian, because they're signing on behalf of your IRA. So it's still your deal, but it's that arm's length thing that the IRS likes so that they can track that money.
Understood. So just to make sure I heard you correctly, so did you say that if you are transferring your IRA, it would take about 3 to 4 weeks, or is that if I'm even starting fresh?
That's a transfer.
Okay. So, and if I'm starting fresh, I think you said 1 to 2 days? Yeah,
you'd have your account open in a couple of days. You can wire a contribution in or send a contribution check in, and away you go. Yeah.
So if an investor has a deal that they're working on closing, they need to close in 2 weeks, and they want to come to you and start working on it today, that's something that could happen.
It could. Yeah, and the 3 or 4 week thing is really if you're using checks to go everywhere, so the mail and yada yada. If you do everything by wire, and there usually is some fee for that, so fees, the wires do cost a little more, but if you're willing to do that, that money is much more instantaneous, and you can, in some cases it can be, a week or a week and a half or something like that and be ready to go. And we try to talk to our account holders right up front about, hey, is there a time, limit or a deadline that this investment that you have in mind is working under, so that we can, help to meet that or not.
Right.
But more often than not, the one way or another, we're able to get the money in position to make the closings.
Understood. And then here's another one that came in also from David. So he wants to know, at what point are you able to take your money out of the IRA without paying a penalty? Is it an age?
Right.
Is it a time frame?
Yep. So with a traditional IRA, it's pretty simple. It's once you hit 59 and a half, you're able to start taking distributions without penalty. And in between 59 and a half and 72, you actually have total control over how much distribution you take. You can take some of it, you can take all of it, you can take none of it. Now, when you hit 72 in a traditional, and this is not the same for a Roth, you have to start taking required minimum distributions. What's happened is the IRS has given you this money for years or decades or something and not taxed it at all. And they're just freaking out. They got to get some tax money. So they say, okay, at this age, you have to start taking a percentage as a distribution each year from starting now and thereafter. But 59 and a half is where the penalty goes away, both for traditional and for Roth. Roth distribution rules have a lot more nuance to them, in as much as I think the big one is that any contribution that you ever make to a Roth, you can actually take a distribution of that money at any point without penalty and without tax. And the reason is because the IRS has already gotten their tax money on it. So they're not worried about it. Now, if you've made a Roth contribution and that contribution has generated an investment return, that's a different story. That you can't get without penalty until 59 and a half. But the actual contribution amount, and this is kind of a nice safety valve that Roths have, is that when you make contributions for them, if you get in a jam, you can take out the contributions without ramifications. So, but the Roth rules are a little bit different, but 59 and a half, generally speaking, is the age for the penalty to go away.
Understood. So correct me if I'm wrong, but it sounds like Roth is one of the safer sides to go with, as along the lines of if you think you may need to pull that money out, so you could always get your principal or contribution, as you called it, back without paying a penalty on it. But once you make a profit and there is a profit in there, that is now penalty if you take it out early. Okay.
Right. Yeah, I don't know about safer, but it has a little bit more flexibility to it.
Okay.
Another thing, just since we're talking about it, I'll just say this so that everybody understands that, the tools you can actually make a traditional to Roth conversion. So if you have an old 401k, that's typically in the traditional IRA tax format, but anytime you want, you can actually make a conversion. And what that means is that whatever amount the raw gross number of dollars that you convert, that actually goes on your taxes that tax year. So you're converting that money from pre-tax money to post-tax money. Mm-hmm. Now, the benefit of that is that, again, at the end of the day, if you take a qualified distribution, there won't be any tax further. So I do see some strategy for our account holders moving into a Roth for one reason or another. One of them is, holy cow, I think this investment is going to be a very low entry threshold of cash, but the possible return is gigantic. Mm-hmm. And so because all of the earnings would essentially be tax-free in a Roth, that might be the better tool for the total gross taxation, right? You scored big. Right. I'll tell you a story. I'll try not to go over too much time, but
sure.
We had I know an account holder who he had a Roth. He converted the last, $30,000-$40,000. So he ended up having about $93,000 in a Roth. So first of all, good for him, nicely done. And second of all, he was in the real estate business, had some expertise. And so he and some friends entered into a land speculation deal. So they all combined their IRAs, their Roth IRAs into a LLC, and they went out and bought some tracts of land. They were just raw land. Well, lo and behold, they did this late 2008, early 2009. So the land that they bought was at its bargain basement price. So 4 years later, his share of the LLC that he bought for 93,000 was worth 970,000, and he sold it. So 800 and, oh gosh, too much math for me, 800 and something $1,000. He's never going to pay tax on because it was housed in a Roth.
Wow.
And this is not an older fella. I mean, so that money can keep growing, and still all of it is tax free. So again, right tool for the right situation. And that, listen, your results may vary.
Right.
Certainly I've never had quite that big of a win, but the idea is to, match the tax tool with the investment. So you do have some strategic things in it. Anytime anybody wants to talk about these things with me, I'm kind of a geek about it. So just call me. We'll talk about it, because I want people to know what the rules are so that they can use the tool as best as can be.
Of course. So if they wanted to reach you, how could they reach you?
The easiest thing is probably email. So it's C Malcolm, CMALCOLM at advantaira.com. That's usually the most reliable, but you can certainly call the office, and my extension is 1147. Just dial it in there and it'll go right to me, and away we go.
Absolutely. And I'll make sure that everyone gets your information in the email tomorrow with a copy of this webinar.
Cool.
Now, is there anything else you'd like to say before I open up to more question and answers from the participants?
Yeah, the last thing I'll say is just, we've talked about this mostly from the perspective of your IRA making money. But one of the things that's nice about knowing that this exists is that sometimes if you're structuring your deal and you're looking for partners, you may be the person who introduces them to the idea that their IRA can participate, and that may help you with your deal. So do think of it as it's just a piece of knowledge, a knowledge base that you have now. So when you're thinking about possible funds and where they are and where they can come from, this is a possible source. So I always encourage people to think about it that way too.
Absolutely. That is gold. If someone is, a lot of people in our field, at least that I speak to, are always looking for private money, always looking to speak with more people to get them on board with their investment. So if you could educate them a little bit and explain to them what they have and how they could participate,
right,
I think you're going to open up more doors for yourself as well as that investor, and they will love you. So keep that in mind, use it as tools. Looks like we got some questions coming in. So we got one from Jim Mooney. So Jim wants to know, is there a recommended minimum amount to roll over into a self-directed Roth? I have two daughters, 18 and 16, with about 88 and 800 invested. So a total of 9,600. I respectively in Schwab custodial Roth IRAs. If I roll them over into an SDR IRA, with any gains be eaten by fees, or should we wait till they have more built up?
Yeah, that's a great question. I get that sometimes. I think it depends on what investment strategy you have. So there are some investments that are low entry threshold that can pay off big. So if you have a low threshold or low dollar amount investment in mind that you think in the long run can really pay off, then it's worth the fees. But you are intuiting this properly, in as much as if your dollar amount is relatively low and your returns are going to be moderate, the fees that the custodian are going to charge is going to eat that up. So my encouragement for you is to calculate the full ROI on it, and I think your intuition is exactly right. I absolutely see people stay in the stock market or things like that at the beginning. They keep contributing until such time as they build up a cash amount that they know that they can capitalize on. So I think your thought is right, and our fees definitely are part of the ROI equation.
Absolutely, for sure, and that's a huge thing. It's honestly, it sounds very similar to anything else. Calculate your investment, make sure it makes sense, and then overall, if it makes sense, we got a deal. If it doesn't make sense, we try again and go back to the drawing board.
Right.
So now we got two questions from John. So I'll go with the first one. I have read that once you invest an amount of your SD IRA to an investment property, that property cannot be leveraged with a loan on it. It has to be a net purchase. I read once that you invest the amount of your SD IRA into investment property, you cannot be leveraged with a loan on it.
I think I understand.
You understand that? Okay.
Yeah, and that's actually incorrect. So your IRA, if your IRA is looking to buy physical real estate, you actually can get debt leverage on it and increase your buying power. So it's I'll tell you what I think. This is one of the only ways that the IRS, and I realize this sentence is a little clunky, but it's one of the only ways that the IRS will let your IRA make money on money that you never contributed to your IRA. Because if you buy a property and you put 40% down and you borrow the rest from Max, all of the revenues come back into your IRA. I mean, you have to pay the debt service, of course. And you may also have to pay something called unrelated business income tax, which I can explain to you. It's a bit of a rabbit hole for our presentation today, but the long and short of it is that's not true. You can use debt leverage in an IRA to extend your buying power. It typically has to be something called a non-recourse loan, meaning that whoever is the lender, they cannot encumber the account holder's personal assets as collateral. So if that IRA loan defaults, all the lender can really do is take the property. And what that typically means for a lender who's paying attention is that they often ask for 35 or 40% down, sometimes even more depending upon the property, so that they're covered if there's default.
Right.
But you absolutely can extend your buying power with debt.
Absolutely, yes, and we can as well. So now his follow-up question was, what is there, and if so, what is the maximum annual contribution you can put into your SD self-directed IRA?
So that's actually the same as the IRS rules for just the account type. So that is actually the purview of the account type. So for traditional and Roth, I think at the moment it's $6,000 if you're under 50 and $7,000 if you're over 50. HSAs, it kind of depends on whether you have family coverage or single coverage. Employer accounts, one of the benefits of employer accounts, so any of you who are out there who are self-employed, you know, the tool of a SEP IRA or a solo 401k is the big advantage there is that the annual contribution limit for those is 57 grand a year instead of 6,000, right? So if your strategy is to get more money into a tax advantaged account faster, that's obviously helpful. Now you have to be self-employed to work that deal. But to go back to the original question and to stop, going off on tangents, it really is whatever the account type, and the IRS changes that, typically annually, but that's where you find out what the annual contribution maximum is.
Understood. So speak with you because each program can be a little bit different, and just consult with someone like yourself before you do something.
Yeah, or your CPA.
Yeah. Absolutely, guys. So I'm going to give another chance for anyone to ask any other questions they have that's on their mind. In the meantime, by the way, I definitely appreciate all of your insight and everything you have to offer us as far as knowledge and education. I know I'm going to be using a lot of this information for myself personally. I know my brother texted me a few times. That was when I was asking a bunch of the questions. He definitely is probably going to be looking to do something. So
great.
You guys are unsure, this is the time to ask. If you just want to understand better, again, this is the time to ask. There is no bad questions. Anything you learn is just going to help you and help you leverage yourself better and create more business. So I'm going to leave another couple of chances. Oh, we got one more. So David wants to know, what are the penalties if you did take your money out a little bit early?
Well, for a traditional, the penalty is basically 10%. So not only do whatever you take out is taxed at whatever your income tax rate is during that tax year. So that's part of it. And then they add 10% penalty onto that.
Got it.
Now I will say this, and I realize I kind of have a caveat to everything, but there is something called a 72T distribution strategy, if you're under 59 and a half, it has some restrictions to it. But if you know you're going to get in a jam and you're going to need to take distributions before 59 and a half, do look into a 72T or call and ask me about it, or ask your CPA about it, because it's really important to ask questions no matter what. It's sometimes you feel like you're doing something wrong, or you're just in a jam and you don't want to ask anybody about it. But often there is some sort of solution. So please do.
For sure. Yeah. And again, most people are actually, investing into their IRA for their retirement, or this is a long-term gain. This is not, something that most people are looking for the short term. But like you said, obviously we always find ourselves in weird situations. For example, COVID-19, no one would have ever expected this to happen. But things do happen, life happens. So
Sure.
you have, I guess we'll do one more. We're almost at our time, but we'll try to fit one more in. So can you buy, it's a little bit of a weird one, can you buy life insurance through an IRA?
Interesting. You cannot, actually. So there are, of the rules that there are two asset classes that are prohibited for your IRA to invest in. One is life insurance and the other is collectibles. So you happen to hit on one that is out of bounds. It's the collectibles one is really a bummer, because I often have somebody say, hey, I have an expertise in ancient coins or collectible firearms, or they have a real expertise in something and they want to capitalize on it. But unfortunately, I think mostly because those assets are a little harder to value, the IRS has prohibited them. So unfortunately, life insurance is out.
Okay, not a worry. So guys, so no buying collectibles and no buying life insurance with your IRAs. And it sounds like that's the only limitations as far as that. Am I saying that right?
Well, in terms of the broad asset classes, I mean, the self-dealing rules really have to do with who you buy and sell to and from and that kind of stuff. But the broad asset classes, those are really the only two big parameters.
Awesome. Great. Well, guys, I want to again thank you, Clay, so much for everything you've given us over today. Guys, thank you so much for attending and investing in yourself and educating yourself. And the more you know, the better off you're going to be. So by all means, guys, if you have any questions, I'm going to send everybody this webinar and Clay's information as well as ours. If you have any questions about lending, you want to buy a property, you have a buy and hold, a fix and flip, you could let us know. We're always happy to extend ourselves and introduce you to people like Clay who could help you and increase your return on investment and save you more money. So again, thank you everyone for tonight for joining. It's been a pleasure. I had a lot of fun.
Yeah, thanks everybody. Thanks, Max.
Awesome. Take care.